I have watched people repeat the same mistakes for decades, and the root cause is always the same: the human need for narrative and the desperate desire to be right. They enter the market with a conviction, a belief, a story. They search for certainty in a domain defined by probability. They treat the market as a puzzle to be solved once, rather than a complex dynamic system to be modeled continuously. They seek the grand singular truth, and in doing so, they guarantee their own failure. They confuse a well-told story with a statistically robust prediction. The most profound lesson I have learned in my transition from pure mathematics to the applied mathematics of finance is this: the pursuit of being right is a fool's errand. It is a psychological trap that has bankrupted more investors than any market crash. If you are looking for a secret formula, a grand predictive theory that will tell you precisely what the market will do next, you have come to the wrong place. Such a thing does not exist. The market is not a deterministic machine. It is a stochastic process, a vast, noisy ocean of data where the signal is faint and fleeting. It is a non-stationary time series constantly evolving, constantly defying simple linear prediction. My firm, Renaissance Technologies, has generated returns that defy conventional explanation. People call it magic. They call it a secret code. They speculate about insider knowledge or superhuman intuition. The truth is far more rigorous and far less romantic. The real power, the true edge that has separated us from every other entity in this industry, is not our ability to be right more often than others. It is our absolute unemotional mastery of the inevitability of being wrong. This is the paradox of quantitative finance. To win consistently, you must first accept that you will lose frequently. You must structure your entire operation, your models, your capital, your very psychology, around the certainty of error. You must design a system that is robust to the failures it is guaranteed to encounter. The title of this discussion is The Power of Being Wrong and Why It Made Me Rich. It is not hyperbole. It is a statement of empirical fact. My wealth and the success of the Medallion Fund is a direct consequence of a mathematical framework that not only tolerates error, but actively uses it as its primary fuel for continuous improvement. We do not fear being wrong. We rely on it. Tonight I will lay out the 5 core principles that govern this approach. These are not trading tips. They are philosophical and mathematical laws that govern success in any complex, data-rich environment. They are the lessons learned from decades of observing the market's cold, hard, probabilistic truth. Let us begin with the fundamental mathematical reality of the market. In pure mathematics, a theorem is either true or false. The proof is absolute. There is no probability involved. When I was a young mathematician, I lived in a world of perfect certainty. The market, however, is a world of imperfect, noisy data. It is a system of weak signals. Consider the signal-to-noise ratio. In fields like radio astronomy, you might be looking for a clear, strong signal that rises far above the background static. In finance, the signal is often barely perceptible, a whisper, in a hurricane of noise. The vast majority of market movements are random, or at least random relative to any model we can construct. This noise is the collective irrational action of millions of participants, the unpredictable flow of information, and the sheer volume of non-predictive data. If your model is designed to capture a signal that is only 51% predictive, meaning it is right 51 times out of 100, it is a profoundly successful model. A 51% edge is a license to print money, provided you can execute it at scale and manage the risk of the other 49%. But what does a 51% edge imply? It means you are wrong 49% of the time. Driven by narrative and emotion cannot tolerate this. When they are wrong, they question the entire premise. They panic, they abandon the strategy. They search for a new, better signal, a 70% or 80% signal, which mathematically is almost always a mirage, a statistical anomaly that will regress to the mean and destroy them. They mistake a temporary fluctuation for a fundamental shift. We, the quants, understand that being wrong 49% of the time is the cost of doing business. It is the necessary complement to the 51% edge. The error is not a failure of the model. It is a data point confirming the model's probabilistic nature. This is the first principle. Embrace the non-deterministic reality. The market is not a clockwork mechanism. It is a chaotic system. Our models do not predict the future. They calculate the probability distribution of possible futures. When the market moves against our position, it does not mean the model is broken. It simply means the market realized one of the 49 possible outcomes, not the 51. The model was correct in its assessment of the odds, but the outcome fell on the less likely side. The critical distinction is between a statistical error and a systemic error. A statistical error is when the model is correct in its probabilistic assessment, but the random outcome falls on the wrong side of the mean. This is inevitable. You do not react to this, you do not adjust the model, you simply execute the next trade. This is the noise of the system. A systemic error is when the model's underlying assumptions about the market structure are fundamentally flawed, or when the market regime has fundamentally shifted. This is rare, but it is the only time you intervene. The way you identify a systemic error is not by observing a single loss, or even a string of losses, but by observing a statistically significant deviation from the expected distribution of outcomes over a vast number of trials. We look for a change in the variance, in the mean of our returns that cannot be explained by random chance. The emotional investor reacts to the statistical error as if it were a systemic one. They panic on the 49th loss. The mathematical investor only reacts when the losses become so numerous or so large that they violate the laws of probability that underpin the entire system. We wait for the evidence to become statistically overwhelming before we conclude that the underlying reality has changed. This patience, grounded in mathematics, is the ultimate defense against market hysteria. If you accept that your edge is small, say 51%, then the only way to translate that small edge into massive reliable returns is through volume and frequency. This is the law of large numbers in action. Imagine a coin that is weighted to land on heads 51% of the time. If you flip it once, you have a 49% chance of being wrong. If you flip it 10 times, you might still be behind. But if you flip it 1,000,000 times, the outcome is virtually certain. You will be ahead, and your results will converge precisely on the 51% expected value. The more trials you execute, the closer your observed results will align with the true underlying probability. The medallion fund operates on this principle. We do not make a few large high-conviction bets. We make thousands of small, low-conviction bets every day across a multitude of markets and time horizons. Each trade is a single coin flip in a vast continuous experiment. We are not trying to predict the weather next week. We are trying to predict the direction of the next gust of wind. The traditional investor, the one who buys a stock and holds it for years, is making a single high-stakes bet. They are flipping the coin once. Their entire career, their entire reputation is riding on that single outcome. They must be right. This psychological pressure is what drives them to irrational behavior, to hold on to a losing position too long, or to sell a winning position too early. They are playing a game of single trial conviction, which is mathematically unsound. Our system is designed to be agnostic to the outcome of any single trade. If a trade goes against us, it is a small manageable loss, a 49% outcome. The system does not care. It simply moves on to the next trade, and the next, and the next. The sheer volume of transactions ensures that the statistical edge, the 51%, asserts itself over time. We are trading for the long-term statistical average, not the short-term emotional win. This is the second principle. Maximize trials, minimize conviction. The size of the bet must be inversely proportional to the uncertainty of the outcome. Since all market outcomes are highly uncertain, all our bets are small. This is the mathematical mechanism for managing the certainty of being wrong. When you are wrong on a small bet, the loss is negligible. It is a cost of data acquisition. When you are wrong on a large, high-conviction bet, the loss is catastrophic. The emotional investor is constantly risking catastrophe because they confuse a strong feeling with a high probability. They are anchored to their initial decision, a cognitive bias that is anathema to a rational system. The beauty of the quantitative approach is that it removes the concept of conviction entirely. There is only probability. A model does not believe in a trade, it merely calculates the expected value. If the expected value is positive, the trade is executed. If it is negative, it is not. The magnitude of the expected value determines the size of the bet, and in a noisy system, that magnitude is always small relative to the total capital. We are not looking for the 10-bagger. We are looking for the 10 basis point gain executed 10,000 times. This strategy is a direct defense against the emotional fallout of being wrong. If I lose a small fraction of a percent on a trade, the loss is a rounding error. It is a statistical fluctuation. If that loss represents a significant portion of my net worth, it is a life-altering disaster. The mathematical truth remains the same, but the psychological impact is fundamentally different. Our architecture ensures that the psychological impact is always negligible, allowing the system to operate without interference. We trade the short-term noise to capture the long-term statistical drift. The greatest impediment to rational investing is the human brain itself. It is a magnificent machine for pattern recognition, but it is fundamentally ill-equipped for probabilistic thinking and emotionally detached execution. The market is a mirror reflecting human psychology. It is driven by fear and greed, by narrative and anecdote. The traditional investor is a participant in this emotional drama. They are susceptible to two fatal flaws when they are wrong: confirmation bias and loss aversion. Confirmation bias is the tendency to seek out, interpret, and remember information that confirms one's pre-existing beliefs. If an investor buys a stock because they believe in the story and the stock begins to fall, they do not look for evidence that the story is flawed. They look for articles, analysts, and friends who will tell them the story is still valid. They become emotionally invested in being right, and they will ignore all data that suggests otherwise. Loss aversion is the psychological phenomenon where the pain of a loss is felt twice as powerfully as the pleasure of an equivalent gain. When the market proves the emotional investor wrong, the pain is so acute that they engage in irrational behavior to avoid realizing the loss. They hold on, hoping the market will validate their initial conviction, turning a small, manageable error into a catastrophic, portfolio-destroying mistake. They anchor their valuation to their purchase price, a completely irrelevant number to the market. This is the third principle: eliminate the human element. My firm is not run by star traders with gut feelings. It is run by mathematicians, physicists, and computer scientists. We do not hire people who have a passion for finance. We hire people who have a passion for data, systems, and the cold logic of probability. We seek minds that can treat the market as a problem in information theory, not a drama in human ambition. The models are the decision makers. They are incapable of confirmation bias because they have no prior belief to confirm. They are incapable of loss aversion because they do not feel pain. They simply execute the algorithm. They are the embodiment of pure, unadulterated rationality. When a model is wrong, it does not feel shame. It does not feel fear. It registers the outcome, updates its parameters, and moves on. The error is not a personal failure. It is a calibration event. The human mind is constantly trying to impose a narrative on random events. If a stock goes up, the human investor invents a reason. The CEO is brilliant, or the product is revolutionary. If the stock goes down, they invent a counter-narrative. The market is irrational, or it is a temporary dip. They are victims of the narrative fallacy, believing that a complex random process must have a simple causal explanation. The model has no use for that narrative. It only sees correlation and covariance. It sees a deviation from the expected path. It does not ask why it was wrong. It asks how much it was wrong and how that error changes the probability distribution for the next trade. The only question is, does the data still support the model's parameters? If the answer is yes, the system continues. If the answer is no, the system adjusts. The true genius of the Medallion Fund is not the complexity of the algorithms, but the simplicity of the execution. The system is a fortress against the human desire to interfere. Once the model is running, no one, not even I, can override a trade based on a hunch or a feeling. The moment you introduce human emotion, you introduce noise, and you destroy the statistical edge. The most difficult thing we ever had to do was to convince brilliant people to simply stand aside and let the machine work, even when it was wrong. In traditional finance, being wrong is a source of embarrassment. It is a sign of poor judgment. In our world, being wrong is the most valuable commodity we possess. It is the raw material for improvement. Every time our model is wrong, every time the market realizes a 49% outcome, that data point is immediately fed back into the system. The model does not discard the failure, it devours it. It is a self-correcting organism that thrives on its own mistakes. This is the fourth principle. Error is data. Data is gold. The process is analogous to the scientific method, but executed at machine speed and scale. You form a hypothesis, the model. You test it, the trade, and you observe the result, the outcome. If the result deviates from the prediction, you do not discard the hypothesis, you refine it. You do not throw away the experiment, you analyze the unexpected result. The most critical component of our system is not the initial predictive power, but the speed and efficiency of the learning loop. The market is a non-stationary process. The patterns we find are not permanent. They decay, they change, they are arbitraged away by the collective intelligence of the market. This phenomenon is called model decay. To combat model decay, the system must be in a state of perpetual minor correction. We are not looking for a model that is right forever. We are looking for a model that is minimally wrong right now and which can adapt instantly when the market shifts. Consider the analogy of a rocket guidance system. A rocket is constantly wrong about its trajectory. It is always being pushed off course by wind, gravity, fluctuations, and minor engine imperfections. If the system were designed to be right on the first launch, it would fail instantly. Instead, it is designed to measure the error, the deviation from the intended path, and issue a small corrective thrust. It is a continuous process of being wrong, measuring the error, and correcting. The error is the fuel for the guidance system. Our trading system is a continuous self-correcting guidance system. The error is the input. The correction is the refined model. The traditional investor, when wrong, often learns the wrong lesson. They might conclude, I should have bought less, or I should have waited longer. These are emotional, anecdotal conclusions, often based on hindsight bias. The model, when wrong, learns a precise mathematical lesson. It might conclude the correlation between the price of commodity X and the currency pair Y, which was previously calculated at 0.6, has temporarily weakened to 0.4 under condition Z. I must adjust the weighting of this factor in the next iteration. This is a quantitative, testable, and actionable conclusion. This is the power of machine learning in finance. It allows us to learn from our mistakes at a scale and speed that no human team could ever match. We are not looking for a single perfect model. We are looking for a robust ensemble of imperfect models, each one constantly being refined by its own failures. The collective intelligence of these models, each making small independent errors, converges on a highly accurate, resilient prediction. The strength of the system is not in the infallibility of its parts, but in the redundancy and diversity of its errors. If one model is wrong, another based on a different set of data and a different mathematical approach may be right. The system is designed to be wrong in many small, uncorrelated ways, which ensures that it is right in one large aggregated way. We diversify our errors so that they cancel each other out, leaving only the statistical edge. Accepting the inevitability of being wrong is a philosophical stance. Structuring your capital to survive it is a matter of engineering. This is where the mathematical rigor of risk management becomes paramount. The single greatest risk in finance is not the market moving against you. It is the risk of ruin, the risk of a single data, catastrophic loss that takes you out of the game. If you are out of the game, your statistical edge, no matter how robust, is worthless. This is the fifth principle. Never risk your survival on a single outcome. The architecture of resilience is built on two pillars: diversification and leverage control. Diversification in our context is not simply owning a basket of different stocks. It is about trading a vast array of uncorrelated assets, currencies, commodities, futures, options, and global equities across every time horizon from milliseconds to weeks. The goal is to ensure that when we are wrong on one trade, the error is statistically independent of the error on the next trade. If all your trades are correlated, then when you are wrong on everything simultaneously. This is the definition of systemic risk. We engineer our portfolio to have the lowest possible correlation between its components, constantly monitoring and hedging against unexpected correlation spikes. We are not looking for assets that go up. We are looking for assets whose movements are orthogonal to each other. When one model is wrong and loses money, we want the loss to be offset by a gain in another unrelated model. This is the mathematical definition of a robust portfolio. Leverage control is the mathematical constraint that ensures no single error, or even a cluster of correlated errors, can destroy the fund. Our models are constantly calculating the maximum acceptable loss for the entire portfolio, and they size every single trade so that the total exposure remains within a strictly defined, non-negotiable boundary. We use metrics like value at risk and expected shortfall, not as suggestions but as hard-coded limits on our exposure. The emotional investor uses leverage to amplify their conviction. They are so certain they are right that they borrow money to make the bet bigger. This is a recipe for ruin. They are confusing a high probability of success with an infinite capacity to absorb loss. We use leverage to amplify our small statistical edge. We are not using leverage to increase the probability of being right. We are using it to increase the magnitude of the returns generated by our 51% edge, while simultaneously ensuring that the 49% of the time we are wrong doesn't breach our survival threshold. Leverage is a tool to scale a proven low-risk strategy, not a mechanism for high-stakes gambling. This is the mathematical elegance of the system. Small edge, 51%, plus high frequency equals reliable small profit stream. Reliable small profit stream plus radical diversification plus strict leverage control equals massive consistent returns. The entire structure is a testament to the power of being wrong. If we were right 90% of the time, we would not need this complex architecture. We could simply make a few large leveraged bets. But because we are wrong nearly half the time, we must be meticulously structured to survive and profit from that error rate. The system is designed to be anti-fragile. It gets stronger when it is stressed. A loss is not a setback. It is a stress test that validates the risk controls and provides new data for the learning loop. The only true failure is a loss that is so large it prevents you from executing the next trade. Our system is engineered to make that impossible. We survive the small errors to capture the long-term statistical truth. The principles I have shared tonight are the foundation of true financial success. They require a radical shift in perspective from the emotional pursuit of certainty to the practical application. Rational management of probability. If this discussion has forced you to re-examine your own approach to the market, then it has served its purpose. I ask you to do two things. First, if you value this kind of rigorous data-driven thinking, leave a like. It is a small signal that this content matters. Second, in the comments below, write a single sentence describing how you will apply the lesson that error is data to your own life or investment strategy. Not a paragraph, a single sentence. Commit to it publicly. Let me leave you with this final thought. I have spent my entire career studying the mathematics of uncertainty. And the most powerful truth I have found is this. The people who win in the long run are not the ones who are never wrong. They are the ones who have built systems that learn from being wrong faster than everyone else. They understand that in a world of probability, certainty is an illusion, and that illusion is the most expensive luxury you can buy. The market will humble you. It will prove you wrong over and over again. The question is not whether you will be wrong. The question is whether you will be wrong in small, manageable ways that teach you something, or wrong in catastrophic ways that destroy you. Build the system, build the discipline, and let your errors become your greatest teachers. Now go apply what you have learned tonight.